Welcome back. The dynamics of the U.S. economy forcing a new way of thinking, both on Wall Street and in Washington. Our special guest is no stranger to weathering economic storms. As an 18-year veteran of the Federal Reserve serving as chairman, he's the noted author of the New York Times bestseller, The Age of Turbulence, Adventures in a New World. And he is here with us, a CNBC exclusive. Now we welcome Alan Greenspan to the closing bell, along with Paul McCulley, managing director and portfolio manager with PIMCO. Gentlemen, nice to have you on the program.
Thank you.
Dr. Greenspan, thanks so much for joining us again. Welcome back. And Paul, you were on Squawk Box this morning, so you've got an interesting take on what you heard there and bringing it to our audience here. Let me kick it off with where we are right now, Dr. Greenspan. The GDP figures out today. What was your reaction to the growth? And 1 year into this financial upset, how would you characterize things?
Well, I think the big surprise at the moment is, given the extraordinary pressures coming from the financial sector, that the American economy is holding up rather well, actually. And indeed, if you look in a global context, it's even more impressive. One of the reasons, of course, is the fact that when the crisis began just about a year ago, the non-financial corporate sector was in exceptionally good shape. The balance sheets were such that borrowing requirements were minimal, and indeed they've weathered very significantly much of what has created huge problems in the financial system, and only recently are they beginning to feel the pressures. The problem, unfortunately, is that the financial system has gone a whole year now. We've had huge amounts of liquidity engendered by central banks, and it's getting increasingly evident that this is a once-in-a-century type of phenomenon. It is not the standard liquidity crises that we have seen in the past. It's verging on the issue of solvency. And the reason we know this is basically we have seen that only when, for example, in Britain, when Northern Rock was bailed out with sovereign credit, that the system stabilized. And we were we had a very major problem prior to the Bear Stearns bailout. But once sovereign credit was substituted for their credit, that too stabilizes. But it's very clear from the spreads that we see in, for example, LIBOR, OIS, and credit default swaps for the financials, that we have not gotten closure yet. And it's going to take a while. And as Paul knows better than I, having heard me so often on this issue, it's essentially, fundamentally, the price of homes in the United States, which are, of course, determining what the equity is in homes here, and therefore what the ultimate collateral of the mortgage-backed securities is pretty much around the world. And we're still nowhere near the bottom of the home price thing, and we are looking for that as the critical statistic which will create a balance fundamentally in the economy. And until then, I hope we can get a sufficiently stable stock price, because there is the fundamental source of capital from which we get the ability to recapitalize a goodly part of the financial system which surely needs it.
And that's built on confidence. Paul, did you want to?
Well, we all focus on the recapitalization going on in the financial system and the need for equity there, but the real issue is that's just a veil on the diminishing equity in the housing stock in America. And that's the real underlying fundamental, is how much equity do we have in houses? Until we know that, then there's a question mark about the sanctity of the mortgage-backed securities, and therefore how much equity do we have in the levered-up intermediaries. So Alan and I spent a lot of time tracing it back to the original source. In fact, you've been doing a huge amount of statistical work on that recently. What's your bottom line on where we stand on how much we've diminished that equity in the home as opposed to the financial system?
Well, it's quite significant. The critical statistic, actually, from the point of view of foreclosures and the like, is the number of homeowners who have negative equity in homes. I mean, the issue of more loan relative to market value.
We call that upside down in California.
Yeah, well, California does its own thing. I mean, what is, at the moment, as best I can judge, we have about 12 million homeowners who are basically net in the red. And it turns out, and this is the most interesting statistic if you're forecasting foreclosures, that during the rise in this particular statistic from a very small amount of people with negative mortgage, a negative position in housing, it's now risen very significantly, but essentially foreclosures, quarter by quarter, take only about 15% of that. In other words, 85% of homeowners are in their homes. They basically pay their debt service. They intend to live there. And so that I find you can't really forecast foreclosures looking at the delinquencies. There's no lead time.
It's an important distinction, actually, to make, because overall, when you look at it that way, the 85%, you feel like, okay, it's not as terrible as some of the headlines. Let me ask you something about something you said the last time we were together. You said that there was a 50-50 chance of recession. Has that changed?
Strangely, no. I think I think the data at this stage in the United States are not, as often was stated this morning when a lot of people discussing the GDP figures, are suggesting recession. I think, actually, I think we're probably likely to go there. We're right on the brink. And I would be more surprised if we didn't than if we did, given the financial state. But the data show, for example, in the second quarter, this extraordinary decline in inventories.
Right.
And when you suppress the level of GDP because you have very large inventory liquidation,
right, that's
good, not bad.
But was that because the stores were selling things and getting rid of the inventory, or the companies weren't buying anything and filling up the inventory?
No, I think if you look at the data on a month-by-month basis, you begin to see that the inventory sales ratios have been coming down, of course, for years because of technology, the just-in-time process, and it's still going on exceptionally clearly. And when you look at the data, for example, from the purchasing managers, which have a very interesting statistic, which is how do they view the inventory position of their company forward of their plants? In other words, what is their customer's position? And that's been moving up or down, but it's never gotten to the point where we sense there's a glut out there. So inventory controls are really quite good. And at this stage, I think they are the major reason why, in the very short term, why we're fending off recessionary pressures. But there's no getting around it. You look at the initial claims today, you look at the numbers of figures, and most importantly, the rest of the world growth rate is slowing down. And we depend very critically on that. And that's why I'm more inclined towards the recession side than not for the U.S.
Yeah, one of the things in the second quarter was the inventory draw on the motor vehicle side. And we know as that quarter progressed, sales came down. And they left the quarter a whole lot lower than they entered the quarter, and it doesn't look like sales are coming back. So even though you got a big draw on inventories in the second quarter, there's no reason based upon forward sales for automobiles to get enthusiastic, particularly since you've seen the credit crunch move into the leasing market in automobiles. I'm not optimistic on automobiles. I assume you're not either?
No. Well, no, we're going to know what the figures were for July fairly sure. The early discussions on it, it'll be roughly unchanged.
Right, and we know what May and June did, and it was obviously very troubling and a real shift. Yeah. We're going to slip in a short break. Actually, we will continue our conversation in a moment, much more with former Federal Reserve Chairman Alan Greenspan and Paul McCulley, getting their take on the current economic climate and the financial system.